So here comes the role of understanding option strategies. Okay. So first thing I want you to understand is, okay, this is a option chain. On the left side are the calls and the right side are the puts. Okay. If you want to, I told you about the strike price, right? You can buy any call or you can sell any put. You can buy and sell any call or any put at any strike price. So basically, you have to identify the strike price, which one you want to buy or sell, and then you go ahead and buy or sell. Okay. Now, one thing I want you to understand here. Can you see the beautiful symmetry here? So we're starting here, right? So the prices here, if you see, they are in decreasing order. Okay. From starting, if you see, they are decreasing in order, and here, if you see, they're increasing in order. Okay, they're exact opposite, right? So, for example, if I want to buy 68 uh, rupees strike price call, okay. So, how much amount do I need to pay? For this, you need to multiply 2.8 rupees into 9,275. This quantity varies from one stock to another stock. Okay. So, do you remember the premium for Reliance? I think it was around 14,000 or 15,000, right? So, this 2.80, 2 rupees 80 paise into quantity, if you multiply, you'll get some amount, right? That is the premium. Okay. You can buy that premium or you can sell that premium. So, this quantity keeps changing for different stocks. Okay. Now, concentrate on this 2.80. Okay. So, why is this 68 strike price call 2 rupees 80 paise? Why is it not 2 rupee 1 paise, or why is it not 1 rupee 80 paise? What determines this one? So, here we need to understand the Black-Scholes model. Okay. So, these numbers are not random. Okay. The calls and puts that you're buying, they are not randomly priced. There is a mathematical equation that estimates the theoretical value of derivatives. So, basically, uh, the data is continuously input into the computer and then it creates that price. Okay, on the left side and right side. These prices come from this formula. What is the formula? This is the formula. Okay, the formula for both call and put are different. So this C is call price. Okay, the 2 rupee 80 paise we saw, right? So that 2 rupee 80 paise comes from is equal to S0. So this S0 is the current stock price. And all of this, I don't know what they are. So it's a different complex formula. Okay, for call it is different, for put it is different, and then basically this is an example of how the data is input here. So they input all this data, and then finally you will get 2 rupee 80 paise. Okay, that's how that price is determined to be 2 rupee 80 paise. Okay, so we follow European option chain model. American options are a little different from us, so we follow this European pricing model. Okay, this is Black-Scholes, and what they follow is this model. So we need to understand. So those prices, okay, they are affected. That mathematical formula, the 2 rupee 80 paise is there, right? So that 2 rupee 80 paise keeps changing. Okay. So today it might change maybe once or twice. It can change within intraday or it can change day to day also. Every day you'll not be buying at the same price. So what determines that price? These are the main factors that affect it. So these are called Greeks. These are called option Greeks. Each Greek is unique in itself, and each Greek contributes a different thing to the stock price. So delta is sensitive to direction movement, gamma is delta sensitivity. I can explain. So for example, we'll take, so why do I need to understand option Greeks? Okay. So for this, I'll give a simple example. This is the simplest example that I can give. Okay. So theta controls the time decay of the price and vega controls the volatility sensitivity. Okay. This is the change in implied volatility. This is by vega. Okay. So these are the option Greeks. I created little animation. So basically, theta is time decay. Okay, remember the sand belt, TT. Theta is time decay, and Vega is for volatility. Vega is for volatility. Others, okay, right now they're not important. Okay, so in the formula, where do they come in? So here the gamma comes in, here the Vega comes in. Basically, what I want to show by this is these option Greeks affect the price. Okay, let us take an example so that you can understand. So previously I told you this break-even price, everything I told you to forget, right? And I told you to only concentrate on this blue line. Now concentrate on this blue line. Okay, so you can use Sensible to simulate future, past, everything you can use to simulate. Okay, right now what will simulate is right now how many days are there to expiry? 25 days. Okay. So now what I will do is I'll click on, then you can see what happens. See now what I'll do is Today is Friday, 3rd October. Now what I'll do is I'll keep changing it, okay, till we go to expiry day. Now focus clearly on that blue line and then see the gap. Okay, there is a gap right between the blue line and the red line. Now see as we go into the future, as we go towards the expiry, see what happens to it. The blue line keeps coming closer to the red color line. On the final day, what happens? The blue and red color line become one. Okay, so this is why the break-even point is important. This theta is the one that determines this. So as we get expiry, you will get option prices for cheap price. Why? Because the decay starts eating into the price itself. Okay. For this, how can we use it practically? So on the day of expiry, don't buy a call or put. So it has to work double time. Okay. Understand this. So what happens is the theta decay goes like this. So initially in 90 days, the decay is very less. Okay. In 60 days also, decay is okay, relatively less. And as we come closer to expiry day, you can see the theta is accelerating very much. And the decay is the highest on the expiry day. For example, today is 28th October, expiry. And then you feel like today Reliance share will rise. Okay. You should never buy a call or a put on expiry day. So on expiry day, first thing, the decay that is there that keeps eating into the price, and then it has to work double. Okay, the option price has to work double to get profit. So the thing that you need to understand is the longer the time, okay, the lesser the effect of time decay on the option pricing. So the thesis of this is don't buy call or put option on the expiry of whatever it is. The decay is very high on that day. So it eats into, for example, if the option price is some 1,000 rupees or something, so every 1 hour, 50 rupees, 100 rupees keeps getting cut from it till it becomes zero. Okay. So don't buy any option on expiry day because theta decays into the price very fast. Okay. Now I'll give an example of Vega. Vega is volatility. So how does volatility affect the price? For example, here if you see the premium for buying a Reliance is for 1,363, the price is 16,000, right? Okay, so you don't know what the exact price. You don't track it every day, right? So you don't know what is the price of the option. So right now I'm telling it is 16,125. Now let us see that there is an event. For example, it can be Reliance quarterly results or something. So whenever there are results, people buy in large quantities, shares and options. Both they buy in large quantities because if the results are good and if the price spikes, you'll make money. So a lot of people place bets close to uh, result announcement. So any company gives results in 4 quarters. Okay, so the closer to this is one of the days. So the closer the day of the announcement, there is a increase in the implied volatility. So what happens? How will this affect the stock price, the option price? So this is the implied volatility graph. So I'll tell you. So here I have simulated that one. Here you can see that the maximum loss is 16,000, right? So now if you put in implied volatility and increase it, you will get the option price for 30,000 rupees. You understand? So basically what happened is the implied volatility has expanded so much that originally it was supposed to be 16,000 rupees, but now because of volatility, it has become 30,000 rupees. So now the break-even point you need to see. So here comes the concept of break-even point. Here, what is the break-even point? So for this option to be in profit on the expiry day, it needs to be above 1,392 rupees. Okay. So once this point, this is called the break even point on the expiry day, it needs to be above 1,392 to start making profits. Okay, which strike price this one? 1,360. Now same 1,360 price, okay, same 1,360, same expiry, because of implied volatility increase, the option premium, see how it exploded. It has exploded from 16,000 to 30,000. So some people trade based on this implied volatility. What they do, they sell options when the implied volatility is high, so that the implied volatility graph comes to normal, they will make money just on this volatility decay. Okay, So you may understand this concept or you may not understand this concept. What I want to tell from this is these options are not random prices. Okay, there are mathematical formulas that determine them. There is theta, which is decay, and then the decay as we go closer and closer to expiry, theta eats a lot into the uh, price of that option. And then with Vega, what happens is any major event is there, don't do buying or selling because you don't know what the implied volatility graph is. There are separate softwares that track implied volatility. So if the implied volatility is high, you can sell options. If the implied volatility is low, you can buy options. So some people trade on volatility. Okay, so the probability of them winning is high if you trade based on implied volatility. It's a very complex concept. Even if you don't understand, it doesn't matter. Okay. The thing I want you to understand is these quants, these quantitative engineers that are on the other side of the chessboard, they are very skilled in understanding all of these delta options, everything, these mathematical formulas, and they create algorithms that trade based on this implied volatility. Okay. So how can we battle? We can use something called option strategies. Okay. To repair your primary position. What does that mean? Okay. Now let us start this. So right now, let us assume that we are expecting Reliance to rise. Okay, so what did I do? I bought a call. Okay, and the premium is around 15,000 or 16,000 something. Now this blue one I'm keeping, this is not expiry. That's why the blue line is very far away. As we come closer to expiry, this blue line keeps coming closer and closer. Okay, so now let us see what will happen. Call, and then if we are in loss, then what can we do? For example, here you can see that here I am simulating the conditions. Okay, so now I'm clicking the so now stock price is falling. So now what happened? I'm in loss. Now what can I do? I'll make an adjustment. What is the adjustment I'm doing? So basically, right now the thing that is there is 1360 call I bought. So I will sell. Okay, I'll sell a call, a little far call. I can sell one call, I can sell two call, but do you see what happened? Once I sold a call, what happened? Now I'm making money as the stock is falling. Previously, what it is? It was loss. Now I am removing the sell. See, now I'm in loss. I sold one call, okay, and then now I'm in profit. Okay, this is called delta adjustment. So here, what we are adjusting is delta. We are bringing delta close to one. If you put two, so now there is more profit. Okay, as you fall, you are making more and more profit. Now suddenly, if it starts reversing, if it starts going up, then you are again in loss, right? So you can close off one call, and then this is limited loss now. Okay, even now you want to make profit. Now what can you do? You can close the other call also. Then you'll have your original position back. See, now we are going into loss as the stock price is rising. So now what I'll do? I'll close off the second call also. Now what happened? I'm back to the original position, and that original position is in profit. Okay, this is one of the strategies. Real life, this is not how easy it is. The prices keep changing. Right now, what it has done is it has kept the prices same. But in real life, what happens is the prices of those options increase, and you will not get such clean graphs. But the adjustments stand. So here what we try to adjust is we are adjusting delta here. When I'm doing all of this, so in reality what is happening is the delta is coming close to 1. If you click the Greek table here, it will show the delta, gamma, everything. If you click on this, I don't want to complicate it. That's why I'm just showing you the adjustment. So when you buy a call and that is going into loss, if you sell one more call, then your position will change. Like, like okay, and then even if it is again still going continuously down, if you want to increase your profit, you can sell one more call and then the profit will further increase. And right now, and if it starts again rising again, if you exit that call, okay, one of those calls, then your original position will come back. Okay, so this is limited loss, and then you can come back to your original position if it is coming back. Okay, this is one of those adjustments. And then the main strategies are directional and non-directional strategies. So directional strategies are mostly Vega based. So in this, what we are doing is I feel that Reliance share will rise. Okay. So I can do directional studies. There are multiple directional studies. Buying a call is just the most basic one. So you can do bull put spread, bull call spread. So in this, I will show you next how we do that. So these are directional spreads. So in this, there is a direction. You are either guessing through technical analysis that Reliance will rise or Reliance will fall. And then based on that directional movement, you are planning a strategy. There are other strategies called non-directional strategies. So this the one of the most famous ones is uh, low volatility is iron condor. Okay, so I will show the iron condor. This is the most famous one. This is so what is non-directional strategy? So you will draw two limits. Okay, for example, let us take Reliance. I am putting two limits to it. How iron condor works. It has four legs. Okay, so I'll not explain the legs, but I'm showing you what it does. So if I do a iron condor Reliance, it will show like this. So this 1,000 rupees and this is 2,000 rupees, this is 2,000 rupees and this 1,000 rupees. As long as Reliance stays between these two levels, I'll make profit. Okay, it can go up, it can go down, it can go anywhere. It can stop there also. But if it's as long as it stays between these two levels, I'll pocket the premium. Okay. In this, I'll show bull put spread and bull call spread. So how do you create a? So first, you will buy a normal call. Okay, and then see here it unlimited profit, right? Now the loss is limited. How much is the loss? 16,000 is the loss. Okay, and then what I'm doing is I will sell the call which is 200 points away. So 1360 is the strike price. So 1380 strike price call I will sell. So now I have changed it to a bull call spread. Now here what has happened? See, the maximum loss is 5,000. Previously it was 16,000. But the profit also has reduced. But the probability has increased. So let us explain. Let me explain. Remove the sell leg. Now the probability that I will win is 38%. Okay. If I put this one, now the probability has increased. So the probability that I'll be profit is 52%. The sensible software calculates the probability of your winning also. It's just a probability, doesn't mean you will win. And then see with the DK, just 30 rupees if it increases, Reliance, you will make 5,000 rupees profit. Just 30 rupees it has to increase. The break even also changes. Okay, here the break even is 1,392. Here the break even is 1370. Okay, 20 rupees break even, there is difference. The probability has increased. The loss also has reduced. Okay, three, four things have happened because I sold a call. Okay, so this is one strategy. See, as it needs to increase only 30 rupees. The break-even point reduces. Here the break-even point is higher. So Reliance has to move 60 rupees to make profit. 1360, it has to increase to 1390. So 30 rupees it has to increase for it to make profit. But if I call spread, then it has to increase only few, I think 6 rupees to make profit. That's the difference. Okay. So that's why the probability increases if we go for a bull call spread. It doesn't mean you will win. The probability. So that's how you create a bull. So this is a bull call spread. You can do the same thing with put also. You will sell one put and you will buy one put. So basically, it has two legs. This strategy has two legs. One is buy leg, one is sell leg. Okay, and both are calls. If both are calls and you're buying one leg and you're selling one leg, that's a bull call spread. And if you are using puts to buy and sell, then that's a bull put spread. So understand this. Calls and puts are like building blocks. Okay, these are Legos. I don't know if uh, so. Basically, our kid plays a lot with these Legos. So they are individual bricks. Okay, and then you get them at various colors. So call and puts are like building blocks. Okay, you can use multiple ones. For example, let us assume that this is uh, calls and these are puts. You can mix them with all of these and you can create such nice structures. Okay, so using call and puts, they are building blocks. But using these building blocks, you can create multiple strategies, directional or non-directional strategies. Now, previously, what used to be there when I started 2019-20 that time, this all these strategies I had to do manually. So I told you, right, 200 points I will move away and I'll sell one leg and then I'll make a bull call spread. Now life has become easier. See, now just use sensible. You can go down. You go little down, then all the strategies are already there. So you can just select and it will only create bull call spread, bull put spread, synthetic future, whatever you want, it will only directly create. All of the most of the name strategies are directly included here. So it will only tell you this is bullish. Bullish means that you feel like the market will rise. So all of these are bullish strategies. There are bearish strategies. There are neutral strategies. Neutral are non-directional. Okay, so these are the bearish strategies that I'm showing now. So buying a put, you feel the stock market will fall, so you're buying a put. This is a bear put spread. This is again put back ratio spread. This is the synthetic future. So these are non-directional strategies. This is iron condor. Okay, and this is one of the other famous one, Batman strategy and Jade Lizard. These are the new famous ones. So these are also non-directional strategy. The probability, see, the probability of winning is 61%, but the loss is unlimited, and the profit also maximum is 22,000. This is one more call ratio back spread. So here also the probability, see the probability of winning 73%. Okay, so 73% there is a probability of winning. So all of these strategies, you can make adjustments, you can do whatever you want. And this is the most famous one. This is the most widely used because I'll tell you why it is most widely used. So theta play. Theta play means they are betting that the Nifty will bounce between these 2 points and then there will be decay. Okay. So by expiry, what happens? This blue color line will touch the red color line, green color line, right? So what they are planning is they'll put two obstructions like this. Okay. So Nifty has to stay between these 2 points and then there will be decay. And then because of decay, this blue color line will touch this green color line and they will make profit. How much profit? 7,000 and maximum loss is 3,000. Okay, this is little closer to expiry. That's why it looks like this. Real iron condor is little different. Okay, so for example, we'll take Nifty. Okay, so this is weekly. You can change it to monthly, 1 day, 1 hour. What does it mean? So basically, this candle you are seeing, these are called candlesticks. So for one candlestick to form, the time taken is 1 week. If you click on 1 month, so the time taken to form one candle will be 1 month, so on and so forth. So right now I've taken weekly timeline. So it means that this candle to form, it took 1 week. Okay. So here, as you can see, there are multiple weekly candles. So in this, you can ignore the wicks. Wicks, I cannot explain right now. The video will drag on. So right now, let forget about these. These lines are called wicks. Forget about them. Only concentrate on the body. So in all of this, I'm taking only this candle. Okay. So it has a upper limit and a lower limit. What is the upper limit? 24,700. What is the lower limit? 24,500. So for better understanding, I'll switch to line graph. If you click on this, it will become line. So this is the line. So what happened is Nifty fell. Okay. And during this particular week, okay, what happened? Nifty rose and then it fell. Okay. And then next week, it moved on. Okay. So the entire week, this was the movement for that particular week. So now when you create an iron condor, you are creating two red color lines. Okay, so there are total, it has 4 legs, two buy legs and two sell legs. So finally, when you create that one, it looks like this. So 24,880, if it does not cross, you'll pocket the time decay. And then 24,370, these two lines, it should not cross. Here, as you can see, what happened? It bounced between these 2 points, right? So this is how real iron condor looks like. Okay. So the maximum profit will be 6,000. Maximum loss will be 8,000. The probability will be 50-50. Okay. Most of the times Nifty moves within this. This is called one standard deviation and this is called two standard deviation. If you remember, there are probability rate more than the probability will be 68 and 90% or something. So basically, this is the thing that they're planning. When you take a non-directional strategy, the thing that you're aiming for is decay. Okay, so this is the theta, theta based model. So in this, what they're planning is that Nifty will rise, Nifty will fall, but it will be between these 2 points. Okay, and then as we come close to expiry, this blue color line will keep coming, and will touch the green color line. So if you see now see the blue color line, and then I'll show you the adjustment now. For example, you have taken iron condor, okay, and then what happened? The it has started going beyond the range. So I have drawn two red color lines, right? It should not go between these 2 points. But what will happen if it goes beyond those 2 points? Then am I in problem? Yeah, you will face loss. So can we make an adjustment? Yes. Okay. What is the adjustment? So now this is an iron condor. Okay. And then what happened? I can simulate conditions. Okay. I can simulate and then I can change. So this is how the iron condor is created. It has two legs of buy and sell. So buy, sell, buy, sell. So this is closer to expiry. So the shape also keeps changing, iron condor shape. Okay. So this one has same profit, same loss. So the probability is 54%. So it keeps changing iron condor shape as you move closer to expiry because of the delta. Sorry, because of theta, the shape of iron condor also keeps changing. So now what happened? You can simulate the conditions here. So now what I have simulated here, basically I have clicked on this one and I have increased the price. So now what happened? Nifty has gone beyond the red color lines that we have drawn. So it has gone beyond the borders of iron condor. For this adjustment, for example, this is this week expiry, right? This can be October expiry, third expiry. Then what I will do, I will go to the next week, 14th October. Then here, what is happening? Here the price is rising. So I will buy a for week. Okay, now what happened? Now I will make money as the price increases. As the stock increases, I'll make money now. Okay, so I have converted a non-directional strategy into a directional strategy. Previously, it has to be between limits, right? So it was a directional strategy. But now, how I have changed it. I bought a call and I have created 5 legs. Previously, there were only 4 legs, only 4 Lego bricks. Now I added one more Lego brick. Okay, and then I have created. Did you understand? I have repaired it. So previously there were 4 Lego bricks. One Lego brick I have added and I have created a new structure. This new structure has increased probability. First thing, 55%. Second thing, the loss also increases. Previously, if you remember, Iron Condor has some 7,000 loss or something. Usually that's the loss it has. But now, as you can see, the loss has increased because of that adjustment. Okay, so every adjustment costs you stuff. For example, if instead of going up, if it has started falling down, if you buy a put next week, okay, then what happened? Here I have bought a put and now I'm making money as the Nifty falls. Okay. So with one simple adjustment, by adding one more leg to a four structure, I have created a new strategy. This new strategy has more probability and more loss. Okay. So every time you make an adjustment, there is change in probability and there is change in loss also. Okay. And margin also will change because now we have increased the margin. So the loss increases, the margin changes. Okay, all of these things you have to understand. Now, these strategies also fail. Why? Because here emotions are involved. Almost all of the strategies adjustments I know, but still I cannot play this directional game. Why? Because there are emotions here. So, for example, you made adjustment of that iron condor, and then, like I told you, you bought a call, and then it is rising. As long as it is rising, you're happy. But Nifty doesn't move in a straight line. Okay, so it goes up, then it falls, then it goes up, it falls. It keeps making these weird movements. Okay, if you study Nifty or any stock also, they don't move in a straight line. They go up, they fall, and they go up and they fall. So every time it rises, you're happy. But if it continues coming back down, then what will you do? What if you exit the next week call and then again it starts rising? So all of these things, what happens? You can understand the strategies, but very strong emotional. There is something called an emotional barrier in stock market. Okay, so here you have to separate your brain, your emotions from your money. Okay, so once you are fixed that this strategy will work and all your technical analysis is pointing that the stock will rise and you made an adjustment, then you cannot keep changing that. So this is called an emotional barrier. Okay, only few people can break this. I cannot break it. Okay, so this strategy adjustments and all when you do and when if it works, it's fine. But if it comes reverse, that's where the problem happens. So we need to create a strategy that is non-directional and is also non-emotional. Is something like that possible? Yes. Okay. This is possible not by using future and options, but you have to combine future and options along with cash. Till now, if you observe, till now I have never used future. Okay. Till now we have only discussed options because not much can be done with future. Okay. In here you have call put, you can buy, sell. So you have four variables and you can do a lot of stuff. With future, not much strategies are there. Okay. So if you combine options along with cash, you can create a beautiful strategy. Okay. But to understand this beautiful strategy, you need to understand. First, we'll go to basics. Okay. First, what are the states of matter? It can exist in solid, liquid, or gas. Right. These are the only states of matter that they have. In the same way, either an index or a stock. Okay. They can have only three states. It can either rise, it can stay at the same level, or it can fall. These are the only three things that can happen to a stock. Nothing else can happen. Okay. And if you create a strategy using both cash and futures, and then if you can account for all of these and still you are in profit, then that means you have created a beautiful strategy. Okay. I will take an example. Okay. In using Reliance shares, this strategy requires certain conditions for it to work. Okay. So first, what happened? I bought Reliance share. Okay, worth 10 lakh rupees, and then I'm happy. I'm looking at it, and the stock price is rising, and I'm very happy. Now, what happened? Reliance share rose 100 rupees. Okay, so it went from 1369 to 1469, and I'm very happy. But now I'm getting tense. Okay, what will happen if Reliance share falls now? Okay, I have waited so long, and then now Reliance share is falling, and I'll get tensed because my profit will go back to original price. So now here you can create a strategy. Okay. So now what is the strategy that you can create? You can buy a put. First thing what you have to do is with the 10 lakhs, you know how many shares you will get of Reliance? You will get around 10 lakh divided by 1369, you will get around 730 shares. Okay. So now how much price did I say Reliance rose? 100 rupees. So 730 into 100, you are in profit of 73,000. Okay. This is the first condition that has been met. Okay. So now what happened? I'm in profit. Now I am tensed that Reliance share will fall. So now what I'm doing, I'm removing some amount, okay, from my profit, 16,500. Okay. In real life, I'm not removing, I'm adding one more 16,500 cash, and then I'm buying a put. Okay. This put, I'm buying it as a insurance. So now in this thing, if you see, what is the amount that I'm losing? I'm using 73,000. Okay. And then for this to use this, I'm losing 16,500. So I'll be left with 56,500. Okay. Now let us see what will happen. Now there is put cash. Okay. Now let us track them both separately. First, let us see what will happen to Reliance shares. Okay. What did I say? There are only three states. It can fall, it can stay at the same level, or it can rise. These are the only three things that can happen. Okay. So if Reliance share falls by 100 rupees, you that's the price that's the profit that you are in, right? So your entire profit will be wiped out. You will have your original capital. So originally you invested 10 lakh. On the 10 lakh, you made 73,000. So what will happen if Reliance share falls 100 rupees? Your profit will be wiped out. If it falls more, for example, I have taken theoretically 1,000 rupees. Okay. For example, if it falls 1,000, it can fall more, it can fall less. But for example, I have taken it can fall 1,000 rupees. Here, the Reliance share will be this much in loss. Okay. If it stays at the same level, already you are in profit, right? 70,000. So the 70,000 profit will be there. But from here, you see, if it rises one more 100 rupees, you will have double profit, 1.4 lakhs. If it rises 1,000 rupees, you will have 8 lakh profit. So in this condition, in Reliance shares, if you see, only Reliance share, these three are in profit. It is only losing money when the share price is falling. Okay. Now we'll go to the other hand, left hand side. Okay. So I have drawn a diagram to show you. So the only time the Reliance share is in loss is when the market is, when the Reliance is falling. Now we'll go to the we are going towards the put. Here I have taken it to expiry day. I That's why that blue line is not there. Now you track Reliance. Okay. If it stays at the same level, you will lose 10,000 rupees. How much ever Reliance will rise, the loss will be 10,000 rupees only. If if Reliance exits at the same level, it is the loss will be 10,000. But if Reliance falls, okay, the put will start making profit. Okay. The more it falls, the more profit will come. Right. So Reliance put has See, as you are falling deeper, you are making more and more profit. Okay. So Reliance put makes money only when Reliance share falls, and Reliance share loses money only when the Reliance share falls. So now we are combining both. Now what are we? We're getting something like this actual calculation. Okay, this is Nifty put calculation. So it will be in loss. Okay, in three when the stock is rising, when the stock is at the same level, it will be in loss. How much is the loss? 10,000. That is fixed. Okay. But if Reliance share falls, then it starts making money. If it falls 100 rupees, you'll make 40,000. If it falls 1,000 rupees, you'll make 4.5 lakhs. Okay. Now combine both of this. So before combining, so these are the three things that can happen. Reliance share can fall. There money will start coming. How much deep it falls, that much money you will make. If Reliance stays at the same level, you will make 10,000 loss. If Reliance rises also, you will make 10,000 loss. Okay. This is same level. This is rising. This is falling. Okay. So if you combine both, what will happen? Now I'm combining both cash and option. So what happened we'll start from originally first. So what I did, I bought 10 lakhs worth Reliance shares. Okay. And I kept them in my Demat account. After 1 year, okay, suddenly there was profit. Okay. Not today, not tomorrow. After 1 year. Okay. How much profit is there? 73,000. Now I am afraid that the 73,000 profit I will lose. So I bought a put. Okay. And then this put is protecting. This is an insurance for me. How is it an insurance? See here. If Reliance rises, okay, Reliance share is in profit, Reliance put is in loss, you are in profit. If Reliance rises 1,000 rupees or 100 rupees, same thing. Reliance shares are in profit, this will be in loss. Finally, you are in profit. If Reliance stays at the same level, put will be in loss. Okay, but Reliance shares already are 73,000 in profit. So still you will make money. Now, once Reliance share starts falling, the put will start making money. So again, if it falls 100 rupees, this will be zero. Okay, but you will make money on puts. How much money? Again, you are in profit 40,000. If it falls 1,000 rupees, or if it crashes, or if it goes to zero, you will make 5 lakhs. Okay, so this is the only instance where you are in loss. Okay, this is the only instance if it falls very heavily. Okay, so we have created a strategy. Okay, near perfect strategy. It's not perfect strategy because there is one incidence where still we are losing money. Okay, this put is not able to protect the Reliance share if it is falls below 1,000 rupees. So now can we make it little bit better so that all of these are in profit? Yes. So when you add a put to a already moved up share. So this yellow color line is Reliance share. Okay. So what happened? Reliance share moved from here to here. So when you buy a put, what happens is you are locking your profit. Okay, this is what happens in real life. So this profit is locked, and then the only incidence where it will lose money is if it falls more than 1,000 rupees. And that also can be corrected using the next strategy. Okay. This strategy that I taught you is called cash hedge with protective put. So we are locking some profit, and then there is a limit to the downside. Maximum loss you'll make is 1 lakh, even if it goes to zero. That's the maximum loss you can make. And then upside if it goes up again you will make more money. Okay, anyway you are making more money. The only way it loses money is if it falls more than 1,000 rupees. Okay, this is where I have used put as an insurance. So this is a strategy I have used combined cash and future and options to create a beautiful strategy. Now can we make this better? Yes. Now what I will do is here I am selling my Reliance share in profit. Okay, so first what thing happened? I bought 10 lakh worth Reliance shares. And then what happened after 1 year? It went into profit. How much profit it was? 73,000. So total it is 10 lakh 73,000. Now what I'm deciding is uh, I will exit fully. Okay, so 10 lakh is out, 73,000 out. No profit is there. I made 73,000 profit. Out of the 73,000 profit, what I'm doing, I'm removing 10,000 and I'm buying one put. Why am I buying a put? Now I feel like Reliance will fall. Okay, if this scenario, if you see, if the share price rises, okay, you have already logged 73,000 profit. In that, you can remove the put loss. Okay, and then you will get 62,000 profit. If how much ever it will rise, you will make 62,000 rupees profit. This is booked. This is fixed. Okay, and then here, if Reliance share starts falling, you will start making money. Okay, and if Reliance share falls 100 rupees, you will make 1 lakh. On the original, again, you have 73 lakhs again. Okay, the 73 plus 1.1 lakh, you're making 1.8 lakhs on both up and down movement. Okay, and then if it falls 1,000 rupees, here you are making money. How much? 5.6 lakhs because you sold your original shares. Now what you can do? Now Reliance share has fallen 1,000 rupees. You can buy Reliance shares again with the 10 lakhs cash. Okay, so now what you have done? You have created a compounding machine here. So what happened? Let us start from first, like a story. 1 year back, I bought Reliance shares worth 10 lakh rupees. And then after 1 year, what happened? They are in profit. What I have done? I have taken 10 lakh, I have taken the entire money out, and then in that some money, 10,000 rupees, I have taken and I have bought one Reliance put. Okay, and then what happened? Reliance share fell. And then how much did it fell? It fell 1,000 rupees. And then I made 5.6 lakhs profit. Okay, now how much money I have? I have my original 10 lakhs plus 73,000 profit. That is 10 lakh 73,000. On that 10 lakh 73,000, I made again 5.6 lakhs. Okay, again it is somewhere around 16 or 17 lakhs. Now at 16 or 17 lakhs, again I will buy Reliance shares. Okay, I bought Reliance shares again. Again after 1 year, what happened? Again that went into profit. Then I exited. Then I bought one put. Are you understanding? So you're compounding money, right? So when a share moves like this between 2 points, here if you, I have drawn two lines, okay, to show you. Okay, so here what happened? It started here, it rose here, and then it fell. It started here, it rose here, and then it fell. So for example, don't take it as a buying or selling recommendation. I'm just showing you a strategy. You can draw the lines here, you can draw the lines here, wherever you want, you can draw lines, but I'm showing you. Okay, so for example, you bought it here and then it went till here. Then what you're doing, you're exiting entirely and then you're buying a put. Okay, and then it fell. Then you will make double money, triple money, right? Okay, and then okay, you don't feel like this will fall from here. You feel like it will rise from here. Okay, then you can buy a call instead of buying a put. So now what happened? This time you'll make money as the stock is rising. Do you understand? So here how I used my future and options. In first one I used as insurance. Okay, so to limit my downside. And then in this one, I have used for hedging and continuing profits. You can buy call, you can buy put, you can do whatever you want. So we have used options to make extra profits. And we have also used it for insurance. Okay. Now those two strategies that I have taught you, they have names. One of them is called call replacement. Other one is called protective put. Okay. These are just crude strategies. Okay. Which require more refining. Okay, these are like the basic studies in the cash based studies. But you can understand, right? Huh? If you buy Reliance shares here, for example, last year somewhere you bought and suddenly it went till here and then it's in profits. Now you are tensed. Okay, I can draw one more red color line here. So once it reached here, I'm very tensed now that I will lose all of the profit. So what I will do, I'll exit entirely. So from here to here moment, you will make lot of money. Okay, on 10 lakhs, you would have made around 8 lakhs. Okay, 18 lakhs money you made. So in that some amount you can use and you can buy instead of buying one put, you can buy two or three puts. Okay. And then what happened? For example, it fell here. So to continue strategy without understanding technical analysis, you cannot do this. Okay. So drawing some lines and then saying this will rise, this will fall after the price movement has taken place, that is very easy to do. But in real life, now can you tell will it rise from here or it will fall from here? So that requires understanding of technical analysis. Okay. And then there are multiple variations in technical analysis. So first thing I want to explain to you is the free resources that you have to understand. To understand and implement these strategies, first you need to go to Zero University, understand the basics of stock market. Then you understand how to use Sensible. There are many YouTube channels will explain how to use Sensible. And there are many YouTube channels also which explain how to adjust strategies and all. First, you should know how to adjust strategies using options. Then you can move to cash. Don't directly move to cash. And there are many textbooks on Amazon which explain these methods. And then try to buy the ones with foreign authors. You know why foreign authors are important here? So you know why Jane Street is making money? Why is it not trading in the US? Why is it trading in the India? So this future and option strategies right now they are like craze here. Okay, they are a craze here now, but they were a craze back in 1990s and 2000s in USA. Okay, so we are 20 years back to them. So the strategies that are working with us won't work with there in the USA because the liquidity is very high in USA. Liquidity is very high, money is very high in US, and then these strategies won't work there. That's why they're targeting Indians because Indians try to buy more because we have less money. So we try to buy more because to sell also you need lot of capital. It's not like if you want to sell, you can sell. So to sell one lot, you need around 1.2 lakhs. And if it is falling, and then if you don't provide enough margin, the broker will close and you're out of the market. So in US, that's why they don't do it in US. That's why I'm telling all these things that we are seeing, they've already done. Okay, so most of the cash-based option strategies that I have learned from foreign authors. And the Iron Condor one that I told you, right? You buy a call, you're able. I spent 5,000 rupees to understand that strategy. So right now, if you click like if you are clicking Iron Condor button in Sensible, you are getting Iron Condor, right? Previously, you had to search for the buy button, click on buy, and then search for the sell button, click on sell, and then again go 2 points down and then buy and then sell. You have to do all of that. And then previously the graphs and option, the charts, everything was not there. So we had to do everything on our own. Now it has become a little easier to adjustments and everything. The option Greeks are also added now. Previously there were no option Greeks. So foreign book authors are very good. So first thing you have to understand is option Greeks. Multiple YouTube channels are there. Don't try jumping into future and options without understanding Greeks and their significance. Okay. I have tried to teach you little bit, but they're a little more complex than I told you. And then first line option strategies. Then you have to learn technical analysis. So like I told you, so the strategy is a good one. But there are two main requirements. One is the 10 lakh cash you require. Okay, first thing, not everybody can buy 10 lakhs worth Reliance shares. So that is a little this thing that will filter most of the people out. Okay, and then that works only with 10 lakhs because the profit is more than the put by option amount. Now that's more than that. So there are a few criteria that are there. I didn't teach you because it's a crude form of strategy. It won't work. I mean, it will work, but you need more capital and like timing also should be perfect. So, what if you bought a put and then the stock rose? So, you need to understand technical analysis also. There are multiple technical analysis tools and studies. Multiple YouTube channels are there, free ones. You can use it. Try to learn from foreign authors. And there is one Theta DK, Theta Gainers, I think. There's one YouTube channel. They teach mainly Theta DK strategies. Okay. And then combine cash and option strategies. These are very less. Okay. The strategies that I had to teach you, I had to undergo a lot of like it was very deep. So it was not easy to find these strategies. But then again, I refined and I back tested and then forward tested. So for back testing, I used Opstra and Sensible both. But now what happened? Now ChatGPT we can use and you can take data from NSE website. You can feed that data to ChatGPT and you can tell to back test it. ChatGPT is doing okay, but then I don't trust even Opstra and Sensible backtesting. They will work when every strategy will working backtesting. So one more thing, one I will do is forward testing. So what is forward testing? I will show you once. So account. Okay, this one I have been using since 2019 or 20. Okay, see, don't see the profit and loss or something. There's a new strategy I'm trying based on Vega. So check the number of portfolios. Okay. So we are going to 14th page. But this will take us to 14th page. Okay. These are the portfolios. So what are these portfolios? Reliance Iron Butterfly. I didn't tell you about Iron Butterfly. It's a Vega based strategy. So in this, what I do is I place these butterflies and everything. And then what I do is I monitor them over time. Okay. And in real time, what happens to them? And if I make an adjustment, what happens there? Okay. And then you can see here, sometimes there are strategies within strategies there. So click on that 16 December strategies. You can see that there are multiple positions here. Iron Condor, Straddle, Strangle, every butterfly, long butterfly with small wings. Some strategies I invented. Iron Condor was one that I used a lot. But so, and then you can create notes also. Like, for example, now they have added this. So previously I used to note down in paper. So this trade worked because what happened? Okay, I made this adjustment. Why did I make this adjustment? Okay, so you can and then this is done in real. You use fake money for this, but it simulates close to the real thing. So what will happen in real life, that will happen here also. Okay. Then I make a chat log. I mean trade log. So this is November. This is 2024 one. I think from 2021 or 2022, I started seriously, and then from 2023, I think I started maintaining in Google Drive, so that all of the trades that I take, why did I take those trades? So Sensible, I told you, it added notes features. I don't know when it added, but I didn't see till last few months. So then if you click and open these, all the trades that I've taken, why have taken, have they ended in profit or have they ended in loss? Okay, and then some learning point will be there for that month which I learned. So I put a big red color box and I enter in there. You do not do this or do not do that. And then that's how you learn. So that's how you forward test, back test, and don't directly put money in the like whatever strategy you learn. No, don't try to put the money directly into the strategy and real money. Okay, first test it, back test it. Okay, back testing means like I told you, you can manipulate Sensible, right? So what will happen if I had done that, and you can change the price, you can change the date, you can do whatever you want with it. Then you can use ChatGPT in recently. So that is also doing not bad. It is doing well. Sometimes you have to correct it. Sometimes it little oversimplifies things. And then forward testing you have to do. So for me, the strategy that the one that you saw in profits, that I have been running since September. I used 1 crore capital, fake capital for that one. And then I will run it for 1 year before if I want to teach people. Then right now the strategy that I will be teaching will be so right now let's come to paid courses. So I am also teaching. So this is my future and option classes. So all of my studies are using cash. Okay, everything is with cash. Nothing is without hedging. No adjustments and all. Any adjustment you have to make, will make with cash. Like I told you, those strategies they are further refined. Base remains the same. So for beginners is the beginners to stock market class. So this one is for people who have no idea about stock market. So in this I'll be using in this I'll be teaching a lot, but in this also I'll use future and options. In this, how I'll use future and options, I'll be using them like insurance. Okay, in case market crashes, you need not panic. Okay, at least to some extent, some money will be there. Okay, and then we'll invest some money in liquid and debt funds also, so that if there are market crashes, you need not worry. You can sleep peacefully. And then after completing beginner classes, or you can take directly intermediate classes. Here I will teach technical analysis. I like price action, so that is the one I will be teaching. So future and options I will also will be using here with cash. Okay, for swing trading. And then advanced classes will be only future and options. Okay, and then here we'll create cash based, not future, only options. And then we'll create small profits. Okay, so at least 25 lakhs will be needed because this is all cash based, right? So the cash based studies, they all require money. So in this, what happens is you'll make money in future in options, or you'll make money in cash. So if you're making money in options, you won't be making in cash. So that's how it runs. So I will be creating another video on all of this, what I'll be teaching and all of this. But anyway, all of these are available on internet. It's not like I have invented these strategies. I have modified them, some according to Indian standards. So our Indian, so basically all of the strategies that these people teach, the foreigners, they will say you buy 6 months later. For example, we are in October now. So they will say after 6 months, October, November, December, January, February, March, go and buy March call. Okay, and make adjustments there. In our real life Indian market, how it is, even this month, sometimes we won't get liquidity. This month, only Nifty, I think, has very good liquidity. Nifty has some liquidity next month also. But if any, like, except Reliance and HDFC and few other shares are there, other than those shares, none of them have liquidity. Okay, and all of these foreign classes, they will start with, okay, first you buy 6 months later call, and then you adjust that with seventh month sell. So those things, they didn't work here. So I had to modify it according to Indian stock market. You can also do it. It's not like it's this thing. What I do is I will be like using my experience in all this back testing, forward testing. I have concentrated and I have created these studies to make life easier. So it's like this. Okay, so this is called a Lego base plate. Okay, our kid loves this. So on this is the one. So once you complete all the three courses, you'll have this Lego base plate. On this, you can create anything you want. Okay, you can make maybe studies better than me also. But the thing is, you'll have a strong foundation on which you can do whatever you want. What's the worst thing that can happen? You lose the money for the course that you paid. But yeah, you understood what I'm trying to teach. So if you're okay, if you're happy with the thing, you can subscribe to the Telegram channel, which I'll be including below. And then yeah, thank you.